Good afternoon, ladies and gentlemen. Welcome to the 30th of June weekly market review. A lot of things has been happening, but it's been a good week. So unpacking all this development with us today, of course, will be Gerald. How are you, Gerald?
Hi, Sunny. Hi, everyone who has joined us today. Yes, indeed, we have had a good week in the global stock markets, where we see that many indices actually reached new all-time highs. And I want to be able to share what are some of the reasons that is driving this improvement in sentiment.
Yes, definitely a very good week that we have seen in the past 1 week. We got the ceasefire on the Iran and Israel conflict, and then we have got the 9th of July tariff deadline coming up, and Donald Trump is expecting to announce 10 over trade deals that is coming. And of course, there could also be the rate cuts coming as well towards the end or the second half of the year. So S&P 500 is up about 4%, Nasdaq also up about 6% month to date. So Singapore index STI is also within touching distance of the 4,000 handle again. So some of the sectors that are driving this rise up in the global indices will be the REITs and bank sector on the Singapore side. So Gerald, I'll leave it to you to share up with us more details on those.
Sure, thanks, Sunny. Before we start, the usual disclaimers that today's sharing is for informational purposes only and is not taken to be financial advice. If you find our weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So we saw that the markets did well in the past week. We have the S&P 500 up by 3.4%, now back to above the 6,100 levels, and also reaching a new all-time high. The Nasdaq also did well, with gains led by Nvidia, which is also at a record high, and reflecting a 4.2% gain in the past week. So apart from two of the factors that Sani mentioned earlier, the easing of tensions in the Middle East, expectations of some trade deals that are going to be announced. Overall, we also see that the rate cut expectations have been more elevated. So with the cooling down of inflation, we have seen that there are rising expectations that the Fed will accelerate on the interest rate cuts. So if you have been following our weekly market review, we often share the CME Fed Watch tool, and this gives us an indication around current expectations of interest rate cuts. So if I were to follow the blue column here, what we see here is that in the upcoming meeting in July, there's still a very high probability that the Fed will keep the interest rates unchanged at 4.25 to 4.5%. But what's interesting to me is that through the rest of the year, there is increasing expectations that we may see more rate cuts, potentially one in September, one in October, and one in December, which will bring the total number of rate cuts to 3, versus the 2 that were previously expected. So that is one of the reasons that is also driving this improvement in sentiment towards the stock market. Okay, so this actually shows the probability of the rates at different points in time. And we see here is the expectations for the December meeting. I just wanted to use this chart to highlight that if I follow the current expectations, which is the dark blue column on the left, what we see here is that by the end of the year, there is now a higher probability of it being at the 3.5 to 3.75% level, which is effectively implying 3 rate cuts from the current level versus, say, 1 month ago or even 1 week ago, where the likelihood was significantly lower. Okay, so this effectively reflects the fact that investors are now putting in a higher probability towards more rate cuts through the rest of 2025. So we see this being reflected in various government bond yields. The US 10-year government bond yield has now come down to about 4.25% from about a high of 4.6% in May. We see this even more significantly in the 1-year government bond yield, which has come down to below 4% in anticipation of the rate cuts. And closer to home, this is the Singapore 10-year government bond yield, which has continuously fallen since the start of the year. And if you are an investor of the Singapore savings bonds, you probably realize that the bond yields have been coming down as well. Okay, so in terms of the top performers in the Singapore market over the past week, we see a number of REITs that have done well over the past week with the fall in the bond yields. We see a bounce in some of the names that were impacted by concerns about the trade, war, concerns about the Middle East tensions. And also we see SGX here with a 7.1% gain. Apart from the STI now back to close to all-time highs, there's also been news of an increasing pipeline of potential listings on the Singapore market. So that's also helped to lift sentiment towards SGX. In terms of worst performance, we see some profit taking in names that have done well previously, including Sembcorp Industries, including ST Engineering, as investors switch to some of the names that have been not doing as well over the past few months. So one of the sectors that has actually still been not doing so well this year would be the REIT sector, because the rates have not come down as quickly as expected. But that appears to be turning, as we see in terms of the performance of some of the REITs over the past week. We also see a pipeline of potential REIT listings. One of those that has been in the news is the filing by NTT, which is a Japanese company, for some of its data center assets in the global market. So at this point in time, I wanted to share more about two of the existing data center REITs in the Singapore market, where we expect that there will be more spotlight with this potential new listing in the Singapore market of another data center REIT. Okay, so the first, which many of you will probably be more familiar with, will be Keppel DC REIT. I've shared more about Keppel DC REIT in some of the previous weekly market review. It was also included in the Straits Times Index in the past week, and we see that the share price has effectively bounced fairly significantly from the dip during the Liberation Day, and with the news about the inclusion in the STI, it is now at about $2.33, which is close to the 52-week high. Okay, so just a quick recap about Keppel DC REIT. It is the larger data center REIT that is listed on the Singapore market. Total assets under management of about 5 billion. The bulk of the assets are in Asia Pacific, which make up 81% of the assets. And more importantly, Singapore would make up 65% of the assets. The remaining assets are in Europe, which make up 19% of its portfolio. Okay, if I were to just do a quick recap of Keppel DC REIT's earnings in FY24, it was one of the few REITs that managed to grow its distribution per unit at 9.504 cents, and that represents a growth of 1.3% compared to the previous year. The REIT managed to grow its net property income such that even with the increase in finance cost, it was actually able to report a higher distributable income as well as distribution per unit. Okay, in terms of the balance sheet of Keppel DC REIT, aggregate leverage fairly low at 30.2%. That is because they also did equity fundraising together with the acquisition of two assets in the Singapore market. Okay, interest coverage ratio at 5.8 times, so that is very healthy compared to what we see on average for the Singapore REIT sector. Okay, so what is helping the strong performance of Keppel DC REIT is also the positive fundamentals of the data center market in Singapore. We see here that the utilization rate is close to 100%, even with the increase in supply that is coming up over the next few years in the Singapore market. Okay, the next data center REIT is Digital Core REIT. What we see here is that compared to Keppel DC REIT, it has not done as well over the past 1 year. But even then, we have seen a bounce in Digital Core REIT's share price over the past 1 month as it recovers from the sell down from the Liberation Day tariffs, as well as improvement in sentiment towards the REIT sector over the past 1 week. Okay, so a quick recap of Digital Core REIT's portfolio. Assets under management of 1.6 billion, so that is slightly smaller than what we see for Keppel DC REIT. And in terms of the portfolio breakdown, it's got assets in the US, in Germany, as well as in Japan. Okay, so in terms of the geographical breakdown, it is slightly different from Keppel DC REIT, given that it doesn't have any assets in the Singapore market. If I were to look at the key customers of Digital Core REIT, what we see here is that it's got more than 100 customers. A significant portion of them would actually be hyperscalers, and this would actually be Fortune 50 software companies or tech companies. Okay, if I were to look at the performance of Digital Core REIT, in FY24, the distribution per unit came down slightly by 2.7%. So that is in contrast to what we saw for Keppel DC REIT. But if I were to look at the second half performance, then that has improved slightly, where it actually managed to report a 1.1% in its distribution per unit. That is driven partly by the improvement in gross revenue that we see, as well as an improvement in the net property income. If I were to look at the balance sheet of Digital Core REIT, the aggregate leverage was at 38%, and the average cost of debt at 3.8%. Okay, interest coverage ratio 3.7%, so that is slightly below what we see for Keppel DC REIT. Okay, in terms of what is driving demand for Digital Core REIT's assets, earlier we saw the utilization rate for the Singapore market was very high. If I were to look then at the North America market, which is where the bulk of Digital Core REIT's assets are based, effectively what we see here is that there has been a growth in demand for data center assets with the increase in cloud usage, and more recently with the increase in AI demand. Okay, what is also important to note about Digital Core REIT is that it has got a sponsor that has a very significant pipeline of assets. So that is Digital Realty. For those of you who may not be familiar with Digital Realty, it is actually the owner of a very significant portfolio of data center assets globally. And they believe that with this pipeline that they have, that will increase the likelihood that Digital Core REIT can potentially make potential acquisitions in future. So what we have seen for Digital Core REIT is that it has been diversifying its portfolio outside of the US. One of the recent acquisitions is in Japan, where they acquired this asset for an agreed value of $413 million. Okay, so with this, we have seen that Digital Core REIT's portfolio is not so much concentrated in the US anymore, but also having assets in markets such as in Germany as well as in Japan. When they acquired this asset, the expected accretion to the distribution per unit was at about 1.8%. Okay, so there's a comparison of the different REITs with data center exposure in Singapore currently. What we see here is that in terms of those that have got pure exposure to data centers, effectively were the two that I shared earlier, Keppel DC REIT and Digital Core REIT. Mapletree Industrial Trust and CapitaLand Ascendas REIT would have data center assets as well, but they would be a smaller part of their portfolio. Digital Core REIT is the only one with 100% freehold assets. And if I were to look at the valuation, Digital Core REIT is also the only one that is trading at a discount to book value, while the remaining three REITs are trading at a premium to their book value. Okay, so this is what we see for Digital Core REIT's book value, price to book valuation, currently at about 0.7 times price to book, which is below the historical average, as well as what we see for other data center REITs. Okay, so we are coming to the end of the month. As we start the new month in July, we have a new Singapore savings bonds that is open for application. We also have the 6-month T-bill auction that's coming out on Thursday. And apart from that, we are just looking out for the US jobs data to provide us with a further indication on the strength of the US economy and also what that means for US rate cuts going forward. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Hey, thanks, Gerald, for that sharing on the data center REITs in Singapore. So, in case you're wondering how come there's so much coverage on the REITs counters recently in the media and on our sharing on weekly market review, we are at the halfway point of the year right now, and it's a good time to do a sort of a portfolio review, rebalancing or reallocation. So, looking at the interest rate direction that is heading towards the second half of the year, it would likely be that interest rate might be coming lower, okay, going down lower, and hence that would benefit the REITs. So on the second half of the year, I think STI will still continue to remain strong and continue to perform because economy is still doing quite okay, pretty well, and companies are still performing well. And REITs could be coming back, and that could be the next driver or the next leg up for the STI index, which the REIT sector has been suppressed for quite a long while due to the high interest rate environment, which is now in the rear view mirror. Okay, so with that narrative, okay, we are unable to give you financial advice, but with that narrative, you can speak with your licensed financial advisor and see how you can rebalance your portfolio. So second half of the year, I'm looking at on the Singapore market, interest rate coming down, that could maybe put a cap on some of the Singapore bank counters that we are looking at because net interest margin might be coming down. So the rise in banking stock share price may not be as fast as what we have seen previously, because of the high net interest margin that the bank is able to make due to the high interest rate environment. And the next up and coming recovery will be the REIT sector. Hence, you can see that there's a lot of coverage on the REITs side on our weekly market review. Okay, so that is the narrative that we are looking at going into the second half of the year. Back to the STI index, we can see that last week was quite a wonderful week. So we have STI is up about 2%, I believe. So you can see year to date we are up about 4.5%. For the past 1 month, we are up about 1%. So we more or less recovered most of the drop that we see in April, and we have also been quite positive for the year as well. So market has already forgotten about the US tariff that is coming due on the 9th of July, which market is optimistic that the trade deals will be able to be pushed through, and hence those tariffs will be in the rearview mirror. So on the STI index, we are now at the 3,965 points level. We are just down slightly less than 1 point today, so relatively flat on a Monday morning, 30th of June. We are also trending on the upper bound of the Bollinger Band now at 3,965 points. So that could mean that, hey, the further upside, the headroom that we can move up further on the STI could be limited, okay? And of course, just above that will be the previous high that we saw in the April period of this year, the end of March or 1st April this year at the 4,005 points level. So the 4,000 would be a very heavy psychological level to push through. So if we touch that level, I am not surprised we will pull back towards at least the 20 days moving average, which is now at the 3,919 points level. Okay, So I think for the SCI index, looking at the indicator as well, we have the MACD indicators in the positive territory right now. We have a crossover of the MACD above the signal line last Thursday or Friday, and that means that is a confirmation of a uptrend going forward in the mid to long term, okay, according to the MACD indicator. And then on the RSI, we are at the 65-point reading, so we also have limited headroom to go to the 70-point mark, which is the overbought level, and that could see some sort of a technical retracement back to some key support levels that we are looking at. And talking about key support levels, beside the 20 days moving average at about 3009, you can see that there's a confluence or a convergence of the 100 days and 50 days moving average, now at about 3,862 points or 3,783 points. Lower bound of the Bollinger Band at 3,873 points as well. So this is the region, the 3,800 will be a very strong support level for the STI index in case there's any technical retracement or market sort of news that have some negative, short-term negative impact on the market, then definitely the 3,800 level would be a good support level to get in. However, if market continue to trend higher on the strength of the momentum that we are seeing right now, the 20 days moving average 3,009 could be the support, the near-term support that we are looking at first before that could help the SCI touch the 4,000 handle again before we have a more significant retracement. So these are the thoughts that I have on my mind now, looking at the STI index. So 3009, 3008 are some of the key support levels that you should be looking at, and 4,000 level is the one that you should be more careful. Once we reach that level, there could be some kind of technical pullback happening on the STI index. Okay, next let me move to the US indices. So for US indices, you can see that the Dow Jones index performed quite well as well last week. So we, of course, at the beginning of last week, we heard the ceasefire deal that was that Donald Trump announced, and then following in the week, we also saw that Middle East was ready to step in to increase the supply of oil. So in case there is any deepening of crisis in the Middle East, so that helped to stabilize the oil price a lot around the $60, $70 per barrel level. So that is good news for the market. And on top of that, we also have the news that the US trade deals might be coming. So market has sort of become very optimistic and sort of positioned themselves to sort of ride on this positive development that might be coming up in the second half of this year or next month. So for the Dow Jones Index, you can see that we have breached the upper bound of the Bollinger Band at 43,523 points. The next resistance level that we are looking at could be the high that we see in the November last year at 44,486 points, with the all-time high at 45,073 points, which happened during the January, early February of this year. So we still have not reached the all-time high of the Dow Jones Index yet, as compared to S&P 500 and the Nasdaq. So key support level that we are looking at, definitely the most prominent one will be the red line that you see here. That is the 200 days moving average. So this level is at the 42,581 points level. So 42,500 would be a good support level if you're looking at the Dow Jones Index. Looking at the indicators, we also have a positive reading on the MACD indicator, indicating that positive momentum is present, and that this momentum, this rebound that we see since the end of April is likely to continue up further. Okay, so touching the all-time high of 45,000 is a very likely prospect going into the second half of this year. However, the RSI at 67-point reading leaves us with very, very little headroom because we are just 3 points away from the 70-point overbought level, which you can see during the January period. Once we reach this level, there's usually some kind of retracement happening. So do be careful over there. So we have limited headroom. So in the short term, there could still be a short-term push towards 44,400 or 500 level. But once we hit the 45,000, there could be retracement coming back to the 200 days moving average at 42,581 points. Okay, next. Okay, this is the chart I believe both of you have been looking at, which is the S&P 500. We managed to get a new all-time high last Friday at 6,187 points, with the closing at 6,173 points. So that means that there is no further upper bound limit that we could be looking at for the S&P 500 at this point of time. But looking at the MACD indicator is slightly positive. We managed to turn positive last Friday, and the RSI now at 70-point mark, which is where the overbought level is. So you can see that during the middle of May period where we touch this level, a bit of a retracement come in. So I think at this point of time, market is very optimistic and valuations are very stretched. So I think it would be wise to wait for some kind of a pullback, at least towards the 20 days moving average, which you can see over here and over here. Once it hits those levels, there could be that rebound. Technical traders might come in to buy the dip. Okay, so market are optimistic, and any time that there's a pullback in some of the major indices, it could be a chance to get back in on the market. So the first support level, 20 days moving average, now at 6,015 points. So the 6,000 handle will be the clear first support level that we are looking at, with the lower bound of the Bollinger Band at 5,882 points and the long-term moving average, the 200 days moving average at 5,829 points, which you can also see over here in the middle of May. Once we touch that, okay, it rebounded back up. So if it comes down again to this level, it's no doubt going to be a technical buy signal that technical analysts are looking at to get back into the broad S&P 500 index. Lastly, let's move to the tech heavy Nasdaq Composite Index. We also have a new all-time high. The previous time we had the all-time high was in December of last year. So it's a good 6-month period of wait before we come back to this level again. So you can see that index is very stretched now. The valuation are very stretched now. MACD, although managed to break a positive last Friday, but RSI is contradicting that signal. So it could be a positive rebound in the mid to long term, but in the short term, the RSI is telling us, because RSI has a shorter reading period of 14 days. So in the short term, index might be overbought at this level, and hence it could see a short-term pullback towards the 20 days moving average, where we last saw the bounce on the last week at 23rd of June. So that 20 days moving average is now standing at a 19,610 points level. Resistance level definitely is the 20,300 point level that we are seeing last Friday. And further support could also come in at the red color line, which is the long-term 200 days moving average at 18,669 points. Okay, so for those of you who are looking at the Dow Jones, the US indices, I think the index now is what we call price to perfection already. And we are looking to the upcoming earnings season to sustain that. And also some of the macroeconomic data that's coming in, with the first one, the non-farm payroll data, to show that the economy is still doing well for the current, for the sort of the bull run that what we are seeing right now to continue further. Okay, so anything else to add, Gerald?
Okay, so we are into the end of the first half of the year. So far, even though it's been fairly volatile, we've seen actually the markets ending on a more positive note. I think into the second half of the year, there continues to be a lot of uncertainty towards the direction of the Fed interest rate. There's uncertainty on the tariffs. So those are things that we'll continue to keep a lookout for, even though at this point in time, the market seem to be fairly optimistic about developments into the second half of the year.
Yes, so I don't want to pour cold water on this rally that we are seeing, but I just want to quote what Warren Buffett has always said: when others are greedy, you have to be careful. When others are scared, you have to be brave and step into the market. So that is the advice that I would be telling you guys. Markets at an all-time high now. So to go in at this level is going to carry some risk. So it's good to find some buffer of safety, or even look at some of the fundamental stocks that could be performing well, and go back to the fundamentals and see how they can perform on the longer term to be sustained for the second half of the year. Okay, and these are the updates that we have today. Thank you, Gerald, and thank you all the audience for joining us today, and we'll see you next week in the next weekly market review. Goodbye.